What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we are going to cover a strangle. One of the stocks that I have traded before, but I haven't traded recently, is Shopify. It's got a very high IV rank. You've got earnings coming up on the 12th. It's had a very, very nice rally here to the upside. I'm going to be looking at just a delta neutral strangle here. We're going to sell right around the 20-ish delta on either side of the stock. We're going to look at the 70.95 strangle. It's completely flat delta. It trades at a $3.94 credit, uses only $800 in buying power, gives us a break even down around 65-ish and change on the downside and 95-ish and change to the upside going into earnings here. Volatility 75 IV rank. You have monthly implied volatility in the 60 handle, so certainly a high implied volatility underlying. Just looking to get some short premium on here in this portfolio. So we're going to do we're going to route it at 395, see if we get filled, and we can adjust it from there. 392, right at the mid price. 388. There we go, 388 on this delta neutral strangle in Shopify into earnings. We'll see how this one plays out. It's been a wild ride from basically 70, and we can actually pull this up here on our position. So we had the 70.95 strangle. We did it at 388. We're currently marked at 688, $300 loss on this position in just a couple days. So when we put this position on the 6th, the stock was trading at about 80. It's rallied almost 10% here since then over the last 4 or 5 trading sessions. We're sitting at basically highs here. It does report earnings in the morning tomorrow. So to manage this position before the earnings, you have to do it today here. So we're going to do something with this position given the size of this move. I mean, it's been just a really big move, really quick. I mean, we went from here all the way up to 90 very, very quick. So we've got earnings coming up in the morning. The expected move is $13, which puts us somewhere around 80 or 100 on the upside. Obviously, a 103 or 77 would be the exact mark based on the end of the week. A quick trader hack for the expected move. When you look at the front weekly expiration, which is the one that we're looking at here that incorporates the earnings, this will have the most price movement baked into the expected move for earnings itself. What that means is that this $13 is heavily influenced by the earnings announcement tomorrow morning. The trader hack that we can use is we discount about 5% of that number per day left until expiration after the earnings. So we have earnings tomorrow morning, which means we have 3, maybe 4 days of price action after the earnings. So we could discount this value by about 15 to 20% to give us what the market expects, or at least the trader hack for what the market expects the expected move to be for Shopify into earnings. So if we take off 20% of that, let's just round it to $3-ish. Here, it means that it implies around a $10 move on earnings, on the earnings event itself, and then $2 or $3 more movement through the end of the week is what the hack says. But anyway, it doesn't really matter because I need to do something with this position. I've got about 34 short deltas on this position overall, and you can see that by pulling it up like this, or you could just look at the deltas themselves. 10 delta on the put, 44 on the call. I'm going to look to flatten this out a bit, so I want to pick up between 10 and 20 long deltas with this adjustment because I'm leaning short about 34 deltas. I want to cut that 25 to 50%, which will put us somewhere around 10 or 15 deltas here on our roll up. So we're going to look to roll this put from the 70 strike up to the 80 strike. It's a hefty credit of $2.13. You can see my buying power effect won't change. This whole position uses about $1,000 in buying power, maybe a little bit less than that. It will pick up my 15 deltas, which is exactly what I'm trying to do. It'll net me about 20-ish short deltas on the position as a whole, as opposed to being 34, 35-ish short delta on this position. My total credit on this position will be somewhere around $6, which would give me a break even roughly at like 74 on the downside and then 101 on the upside. So big wide range to hit. Of course, I can roll this position and manage this position if needed, but the ideal situation would be basically a non-movement on earnings before the market opens tomorrow. So we'll see if that happens here, but we're going to try and get filled on this. Let's try above the mid price here and see if we get filled. 217, come on. There we go, 217. So we just got filled on this. We've got now the 80.95 Strangle on for $6.05 credit. It's currently marked at 912 going into earnings tomorrow morning. Hopefully there's a big vol crush coming in because this does have an IV rank of 88. Monthly implied volatility in the front, 173%. You got December volatility at 68 and 56 in the back. So you got about 10 or 15 vol points that will come out of that December expiration, or at least I'm projecting to come out of that December expiration if we do get an inside move. So ideally we get kind of a non-movement tomorrow, nice vol crush, and this should be, you know, more towards a scratch. So we'll check this out tomorrow after the earnings. All right, so we've got a shop position that has been a face ripper to the upside. We put this trade on for earnings. We were short the 70.95 Strangle into earnings. The stock absolutely exploded higher. 115-ish was kind of the high there. It's had a little bit of a pullback here, still very much a big losing position, about $600 in change in loss on this position. Currently, just to put an idea of the buying power being used on the position, so I'm using about $2,000 in buying power. So the buying power has expanded pretty significantly here, and that's, you know, all because of the move that we've seen to the upside. I'm now in the money 10 points on the upside here. So it's definitely expanded. This is one of the many reasons why you have to keep size in check, because if this was a 5-contract trade or a 10-contract trade, on entry, I could probably put that sort of size on, but I wouldn't be able to hold it into this sort of move. So you have to be able to hold positions into moves like this, because you should expect to see these every once in a while. So we're getting a little bit of a pullback here in shop, which has helped us a little bit here because we are basically just short the stock here, short at 95 here. We have rolled up the put a little bit, and we did that pre-earnings. At this point, we've got to go inverted on this position, and that's just because this has just become too heavy of a delta position. You're sitting here with basically an 80 deltas total here. It's a 2 delta put and an 82 delta call, so I'm short 80 deltas. So I've got to collect or pick up about 20 to 30 deltas here to cut that number down by 25 to 50%. That's the goal here with this roll. So I'm going to take this position and I'm going to roll up to, like, let's call it the 100 strike, just to go to an even round number. If we roll up, we're going to collect somewhere around $1.90-ish or so. So that'll give us a total credit of, let's call it $7.90 to $8. We'll use $8 just as a round number here. What that means is that we'll be $5 inverted, which means that this spread, the short 95 and the short 100 put, this spread, its minimum value is going to be $5. So this trade currently will likely need to be managed moving forward to get out for a profit. At a $5 intrinsic value to a $7 total credit, it's very unlikely that I'm going to hold this to expiration and get that $2 of value that I can capture, which is the credit over the width of the spread. The spread is $5 wide. The minimum it can trade for is $5. So the max I could make on this position would be $2 if it expires right between the strikes. I'm definitely not going to be able to hold it to expiration without wanting to roll it at some point here in the next couple weeks, hopefully into a down move. Now, if we get this down move, let's call it to 100 or, in between 95 to 100, I'll take this position, roll it out to January, and continue with the process of trying to collect some extrinsic value and manage this position moving forward. So we're going to make this roll here. Let's see if we can get $1.85. Market's moving a little bit. The stock is rallying, which is why our credit is going down because we are picking up long delta into what has been a little bit of a rally in the stock. So we'll try for $1.85, see if we can get filled here. There we go. $1.85 puts us at a $7.90 credit here. Again, big position. It's definitely well outside the expected move, not something that you can play for. You can't really play for a move like that. You can only, manage and try and adjust the position. So this one will definitely be another management moving forward for this trade. So stay tuned for that. Big loser here to deal with. Shopify stock has traded to significantly new highs, 115 here. Our Shopify position short the 95 call and the 100 put. This has been a debacle of a position. We've got to do something with this, just given the move that we've seen, actually having a tiny bit of a pullback today, which is helping us. We're going to take this position with 11 days to go till expiration. We're going to move this out to January. You've got basically zero extrinsic value in this 95 strike call. So I have to do something with it to avoid any sort of assignment risk. So I'm going to take this. We're going to go out to January here and continue the good fight here. So I'm going to look to reduce my overall delta exposure. You could see I'm short 93 deltas. I'm buying back the spread, which is why it shows as a positive delta. So I'm basically just short stock. I want to get that down to like around a 50-ish delta. So I'm going to move the short call up to 100. It is going to cost me a little bit of a debit for this whole position as a whole, but it's going to put more extrinsic value on the table. This has about a 65-cent extrinsic value. I'm going to roll to the 100 strike call. I'm going to sell the 110 put. It's going to be done for a small debit here. It's going to put me in a position where my inversion is actually going to be greater than the net credit on the position. My credit on the position is $7.90. I'm going to be inverted $10 here, but I have to make this adjustment because the position has just gotten too big. You can see I'm reducing my overall delta by about 30 or 40, almost 38 deltas here, which will leave me a little bit more neutral to bearish as opposed to just straight up short stock. So, ideally we get a little bit of a sideways move / down into the 100, 110 mark here over the next couple weeks. I'll be able to roll this out again and keep going with the position. So we're going to get filled on this position for a debit here of $1.42. That puts us at the 100, 110 inverted strangle at a $6.48 net credit. Shopify now trading at 105 here. It's come down about $15 from the highs. It has been a painful position to hold. You can see all these rolls that we've done. We started this in December. It's now time to continue this fight into what has been the perfect move for us. So we've been inverted on this position. We are short the 100 strike call, short the 110 put, which means that we are inverted 10 points on this trade. So the value of this spread can only go as low as $10. That is the minimum this position can trade for because it has $10 of intrinsic value. Anywhere between 100 and 110, this position will trade for a minimum of $10. It's currently trading at $13.60, which means we have $3.60 to make on this position, make back on this position over the next 18 days. A pretty decent amount. The problem is that if you get a move in either direction, let's say we go 10 points higher or 10 points lower, there's not a ton of extrinsic value that's going to hedge us into that move. It's going to be all intrinsic value. We're right around that 21-day mark. We've held it a little bit past that. It's time to take this position and roll it out to February. So we're going to do that here. So January, we're buying back our position. We're going to go into February, and I'm going to try and take off this inverted position. So like we said before, the 100, 110 inverted strangle. It can only trade for a minimum of $10. Let's try and make it so that this roll, we take off that $10 of intrinsic value, or at least a big chunk of that. Let's see if we can do like the 100 strike, and we'll go to the 115. So still fairly delta neutral here. If we go to the 100, 110, we'll definitely do this for basically a scratch or small credit. We'll give ourselves a little bit more room here on the upside. Now, you see this position as a debit. It's a $1.85 marked debit here. But what are we really doing here? We're taking an inverted position that has $10 of intrinsic value, and we're rolling it out in time to an out-of-the-money position that has no intrinsic value. So we're taking off $10 of intrinsic value, and it's only costing us $1.70 now here with our change in the prices here. That means that synthetically, we are gaining the potential for $8 or $9 of value to be realized on this position. If this new strangle stays out of the money, it will expire worthless and be worth zero. Right now, the position that we have, the minimum value it could trade for is $10. So this roll, although it's a debit roll, is netting us value in terms of removing that intrinsic value on the position. So we're going to make this roll, and we're going to roll to the 100, 115 strangle. It is going to be a net debit. It's going to reduce our overall credit on this position down to, $5, $4.50, depending on where we get filled here. But it gives us the potential to exit this trade if the stock stays between 100 and 115. So we're going to make this roll right now, and we'll take a look at where our break evens will be after we get this roll filled. So we'll try it here a little bit below the mid price. We'll work our way up here. We'll start at 175. No fill there. We'll go to 180. No fill there. We're probably going to have to give up a couple pennies here, but there's no harm in trying. All right, so we got filled at 185. What's that leave us? That leaves us with a $4.63 credit on this position. That means that our break evens are right down at 95 and on the upside of 120. Let's see where that is relative to the chart. So that's 95 on the downside here, 120-ish on the upside here, so new highs. We're back to really this gap that it had after earnings. So that adjustment allows us more time, of course, to be right. It gives us a little bit of added theta decay because we're moving further out on the distribution curve. It gives us more room for the stock to chop around. We now have a 15-point range for that stock to move. It flattens our delta. You can see we have basically zero delta on this position, and gives us, overall some more management for this trade. We can always roll up, roll down, depending on where the stock goes. So stick around because we will definitely have some more management on this position. All right, so we've got a big decision to make going into next week. In the middle of next week, the stock reports earnings, and I don't pretend to know whether the stock will go up or down or sideways, or whether the numbers will be good or bad. None of that really matters. What matters is that volatility is getting bid up into this event. You can see IV rank at 84. You can see the implied volatility here, 112% going into next week, which incorporates the earnings move and the earnings announcement. It's the expiration that has the most exposure and most binary risk because of that earnings announcement. You can see the February expiration, which is the expiration we are in, or that I am in, 88% implied volatility relative to the back, which is at 61, 54. So there's a huge volatility skew going into the earnings event, which is not uncommon. It's actually typical when you have a binary event, earnings being the key for, or one of the biggest binary events for individual equity names. You tend to see volatility expand into those events because people are uncertain whether it'll be up, down, or sideways, just like we said at the beginning of this little section. So for me, I'm leaning right now. If we look at this position, I have 64 deltas short on the call and 13 deltas long on the put. So net, I've got about 50 short deltas on this position. It's a lot of delta going into the earnings announcement, especially when it's a very uncertain event. So there's two options that we have on the table in terms of management. We could take this position and roll it out to March. It'll be a little bit less volatile from a risk standpoint. You'll collect some premium as well. It still leans you short. You can see this actually reduces my delta by about 4, so not a huge adjustment to delta, but it does give you a lot more time to be right. For me, I'm going to take a little bit of extra risk on this position and see what happens. The stock has gone so far to the upside. I think maybe we can play a little bit of a down move or maybe even a sideways move and a vol contraction. I mean, that would be perfect for this position unless we do get that down move, which would be the absolute nirvana of a move to somewhere around 105 or 110. I think being a little bit conservative, rolling up the put into this announcement is what we're going to do. So I was thinking to roll this up because when we look to manage positions, we want to reduce overall delta by somewhere between 25 and 50%. So this position has about 50 deltas. So if I was to pick up 10, 15, 20 deltas on this position, I'd be cutting my overall directional exposure by that 25 to 50%. So I'm going to try and do that here by rolling the 100 strike to the 110 strike. Picks up 14, 15-ish delta to cut my overall exposure by about 25%. So you can see this won't use any additional buying power because it's the same amount of risk on the table in terms of the stock going to zero, which I don't think is going to happen. It's going to pick up $2.37 of premium, which is going to put me around $7 of total credit on this position, which means my break even through this 15-day time frame will be somewhere around 103, and on the upside around 123, 24-ish. So we really are looking for a little bit of a downside move, a nice vol contraction, and hopefully somewhere in this 110 to 115 range. So it's going to be very much like a straddle here. Will be our net overall position. So we're going to route this order 237. Probably going to have to adjust this, though, to get filled. Come on. There we go. It's about to replace it. So we rolled that put up. We've got the 110, 115 strangle for $6.97 credit. We are hoping to get back in the middle of this most recent range, the last 3-4 months of price action here. A move lower to 110 would be absolutely perfect. We'll take a look at this position right after earnings, regardless of what happens, because we're going to have to do something with this trade. So stay tuned for that next close or adjustment coming next week. We had earnings this morning in Shopify. Stock was trading at about 120. It had a $10 plus expected move going into earnings. The stock has basically gone nowhere. We had a little bit of move higher in the pre-market session. Once we opened, the stock is now basically unchanged here. So this position, now the question becomes, do you want to continue with this position and roll out to March? You certainly can. For me, for something that I've battled for months, I take the money and run, right? I've had nice winners throughout this duration and some losers, of course. But this trade going from a $600,000, $700,000, $800,000 loser at one point to basically a scratch, that is a huge win in terms of the overall net value that I've captured here. Instead of having to take a $1,000 loser because the position was too big, we stayed small. We were able to manage the trade. We were taking some shots. We took some risk here into earnings. I mean, those are all calculated things, but really the key is staying small in your position so that you can manage it throughout these huge moves, these 50% up moves like we had in Shopify, basically the moment we put the trade on. So for me, I'm happy with the small loss, the 20-cent loser or whatever we get filled here. If it was $100 or $200, I'd be happy with that loser just because of how much we've had to manage this. You can see the buying power has gotten pretty big here as well. So this is a trade. Take the money and run. It worked out for us. We managed this really well. So we're gonna get out of this position and close this position out. 724 or 720 here. See if we can get filled. And there we go. $7.20. We exit for a 20-cent loser. This ends up being a nice trade, a nice scratch of a trade after a couple months. So good job out of anybody else that was in this, that was battling through this with me.